There's two types of capital gains, long-term and short-term. They generally apply to property held for investment purposes. So the way capital gains work is at the time of the sale, if you do not do a deferred tax exchange, you're responsible for the gain you may have. Said gain is calculated based on the sales proceeds minus applicable expenses minus your basis. Your basis, generally speaking, is what you paid for the property. In the instance that you inherit the property and you were qualified for stepped-up basis, that would be the appraisal as of the date of death of the decedent. So capital gains are given preferential tax treatment if they are long-term. Long-term is considered 1 year or more. So if you held the property for 1 year or more, you might be afforded capital gains, which are discounted from your marginal tax rate. Capital gains currently at the federal level are 15 and 20%. It's capped out at 20%. Once you exceed about $583,000 in income or gains, then it's capped out at the 20% level. Up until that point, it's taxed at the 15% rate at the federal level. States vary. A lot of states treat capital gains as ordinary income, so you need to look at your specific state and your individual tax needs to determine what your capital gains are. But like I said, if you hold it for at least a year, you might be afforded long-term capital gains rates, which are reduced from your marginal income tax rates. Step up in basis means that you inherited a property through an estate or a proper trust. Generally, revocable trusts qualify for stepped up in basis. Non-revocable trusts do not. But if you do inherit it and you have a certified appraisal from a licensed appraiser, your basis is determined based on that valuation assessed or determined by the appraiser. That would be your basis going forward. People always talk about, should I sell grandma's land? At the end of the day, you need to look at your individual needs and your family's needs. If there's no imminent need for the money and grandma is getting closer, to no longer being with us, it may benefit the family to wait until they get a stepped-up basis in the parcel. Each tax situation is different, so you're always encouraged to contact your accountant, your attorney, or a licensed professional such as myself that can help you navigate the waters. It's important you're proactive about your estate planning because a lot of times people don't address it until it's too late, and then you can't undo a transaction once it's been done. So to the extent you can be proactive, meet with your accountant, meet with your lawyers, and meet with a real estate professional that will help either mitigate or minimize your tax liability or exposure. The stepped up in basis it's IRS regulation. It does vary a little bit by state to state, but for the most part, most states conform with IRS requirements and regulations. You cannot, to my understanding, do a stepped up in basis for a non-revocable trust. So when you're doing your estate planning, make sure you broach that subject with your accountant and with your lawyer when you're planning for your estate taxes to make sure ultimately you qualify for a stepped up basis for whatever property you may have. There are ways to spread out capital gains over multiple years to get the most benefit, in the sense that if you do an installment sale or a contract for deed, then you pay the capital gains in the future. So if you can do an installment sale and keep that below the threshold of $583,000 adjusted for inflation, then you're going to be afforded the lower capital gains rate of 15%. And there are ways to ensure in the future you can mitigate your tax liability by virtue of doing that. So installment sales are very important. The only risk you take with an installment sale is you have to pay the capital gains rate in the year in which it was sold. So if Congress were to change the capital gains rates, you could have more exposure, but based on what we know now, there's a benefit to deferring some of the taxes into the future. Same concept with a deferred tax exchange. You're basically deferring it until a subsequent sale of the target property. And to the extent you do your estate planning correct, you may have your beneficiaries get a stepped up basis. So basically all the gains are eliminated and they start fresh on the date of your death.